All right, thank you. Today we're going to talk about the current state of market predicting option indicators. There are a number of indicators that we follow that in options, particularly as contrary indicators, that can be useful in helping market prediction. Just a quick word about our company itself. I started the company 25 years ago, mostly as a newsletter research company, but we've branched out into money management. So now we're managing over $40 million in various individually managed option accounts. And we also do a certain amount of option education, such as this webinar, and we also do some mentoring. If you will be sent the PDF of this presentation, so you don't have to do anything to get that. But if you'd like some discounts on any of our products, you can go to this URL, optionstrategist.com/ogweb, and take a look around there. All right, so let's talk about the indicators. There's four main indicators that I use in looking at the market. The first and most obvious is the chart of the S&P 500 index. We'll take a look at that with some little variations on it. Then we look at put-call ratios, which I consider to be extremely important. We look at market breadth, and then we look at volatility, specifically the volatility futures on VIX and the various CBOE volatility indices. So we're going to discuss these in order. So before we discuss this in specifically, you'll notice that some of these indicators right now are in an overbought condition. And many indicators, for example, were overbought for long periods of time in like 2013 to 2015, but the market kept going up. So overbought definitely does not mean sell. It just means that, you know, the market's in a condition where sell signals could arise. But we always counsel people to wait until the put-call ratio or whatever indicator does give a sell signal before you actually act on it. And so because these overbought markets can continue to rise for a long period of time. And conversely, even though that's not the situation right now, oversold does not mean buy either. An oversold market can go down a lot. So you know, you want to wait for actual confirmed signals on any of these indicators. So here's a two-year chart of S&P 500, and there's two main things, maybe three on this chart. First of all is the support line right here. There's also was a probe down through the support line in February of 2014, and here again in October of 2014, and then twice this year, January and February of this year. So roughly the 1810, 1820 level on SPX. And from there, we've rallied mightily all the way up to where we're trading it now at new all-time highs, or very close to them. And when we broke out, we finally broke out over these highs that had existed since last April and May. And then we also had a couple of times come up near that level but failed. So this entire area in here, 2120 to 2130, should be support, because as the market, if the market were to pull back that far, there'd be plenty of people say, oh, I missed my first chance to get in there. Let me jump in there now. So we're viewing that as support. The next chart is just a closer up view of this, and oh, by the way, the blue line there is sort of the trend line of the bull market. But you know, as a trader, you wouldn't want to wait for S&P to fall all the way down and break that trend line. You'd have lost a lot of ground. There would be better opportunities to sell along the way. But these wiggly lines here are what I call modified Bollinger Bands, and I know you just finished a seminar on Bollinger, something about Bollinger Bands. I didn't catch the whole thing. But essentially, we use modified Bollinger Bands with sort of an option orientation towards them. And they've given a number of decent signals over the years. There was a buy signal back here in January, this one right back here, and then we just had another one here on the Brexit trade, Brexit breakdown there in late June. And the way we draw these Bollinger Bands is slightly different from the way John Bollinger defined regular Bollinger Bands. And the difference is that he defined volatility as the standard deviation of closing prices on the underlying, in this case, the S&P 500 index. And that certainly seems to be a reasonable definition of volatility. But turns out mathematicians have a slightly different definition, and especially in the Black-Scholes model, which is what we use to model options, the definition of volatility is the standard deviation of daily percentage price changes, and that's closing price. So your closing percentage price changes from day to day, the standard deviation of those things. And either one is probably acceptable, but since all of our research is option-oriented, and we do put out a lot of information about Black-Scholes models and that kind of stuff, we can't really have a different definition. So using that definition of volatility, we compute the Bollinger Bands in the same way that John Bollinger does it, and these are well, in this case, the -4 and -3 standard deviation bands here, and up on top the +4 and +3 standard deviation bands. So you can see right now that the +4 standard deviation band is right there at about 2,200. S&P right now at this point in time is right around 2060, maybe just a little above. So we still have to go some ways to get up here, and a sell signal arises if we close above that band and then close back below the 3 standard deviation band. So you can see we got these buy signals down here when we close below the band, the 4, and then above the 3. In fact, the next chart is a 2-year chart showing the Bollinger Band signals. The red signals are successful ones. The blue signals were premature and immediately followed by a successful one in all 3 cases. And what we really look for, although it doesn't happen every time, is for the market, the S&P 500, to advance from the lower -4 standard deviation band all the way to the +4. You can see that it did that many times. We had a good buy signal here last September. It went all the way up here to the +4 in really a month almost. Here we have the buy signal in February. We did get up and touch the +4 a couple of times here. We never really closed above it. So we still haven't even closed above it since last February. So, ideally, to get a sell signal on the stock market, we just want to see a modified Bollinger Band sell signal, but you don't always have to have one. You can see, for example, here this decline that took place last August of 2015, was not preceded by a Bollinger Band sell signal. So the market could go down without one, but if you do get one, that's certainly a better time to try to choose a topping area. But anyways, so summarizing what we know about the SPX chart, it's positive that we broke out to new all-time highs. It's positive that the 20-day moving average is still rising. There's no true resistance above here, that +4 standard deviation modified Bollinger Band. That's what MBB stands for. That's at 2,200. That might be a resistance area of sorts, just a fictional one, a technical one. The near-term support is at the old highs at 2120, 2135. So if that were broken, then I would no longer retain the same conclusion, but the conclusion that I have now is that the S&P 500 chart is bullish, and as long as that's the case, we'd retain long positions of some sort. Now, what about put-call ratios? Put-call ratios are, we look at the equity-only put-call ratio. We look at a lot of different ones, but I'm only going to discuss 2 of them here. The equity-only put-call ratios are all stock options that trade, so it's millions of options that trade every day. And this is a contrary indicator. So if too many people are buying puts, if there's too much put buying, then we want to do the opposite. We want to do something bullish. On the other hand, if there's too much call buying, then we want to do something bearish, and we have ways to quantify this. So the put-call ratio was invented by Marty Zweig back in the late 1950s. When he was getting the data out of the weekly ads run by the over-the-counter put and call dealers in Barron's. Now, of course, we're much more sophisticated. We've got computers and everything. So let's just say at the end of the day, we look at IBM options and we sum up the volume of all the puts that traded, and separately we sum up the volume of all the calls that traded. We divide the two. That's the put-call ratio. So since puts are in the numerator of that fraction, heavy put buying makes the ratio go higher, the numerator going higher. But calls, since calls are in the denominator of the fraction, heavy heavy call buying makes the ratio go lower. And I use a moving average. I use 21 days just in case there's something to this Fibonacci thing. And so what we really want to see is a nice inverse relationship between the underlying index or stock and the put-call ratio itself. So, for example, let's say here a stock is falling, and the put-call ratio would be rising because people are buying puts. And during a trend, the public is right. But as we reach the apex of the trend here, the put buyers kind of exhaust themselves and they run out of ammo, and the put-call ratio starts to roll over and curl downwards. That's a sign to buy the stock, which we would buy here. Then call buying takes over until we reach a crescendo of that. So here's this is not a current chart. This is just a chart to show you that the equity-only put-call ratio, which is on the bottom here, is pretty much inverse to the S&P 500 index. And what we're looking for, as I said, is this nice inverse shape. So when we have the inverse shape, we know that we have a put-call ratio that we can essentially trust. And here's the current chart of the equity-only put-call ratio. It gave a nice buy signal back here in September. Remember, a buy signal means that the put buyers exhaust themselves and then the call buyers take over. So had a nice run there, but then a sell signal in November, which resulted in the market going down. A good buy signal in February, and we've been bumping back and forth between buy and sell signals for a while. But the most recent change or trend came in early July when the put-call ratio again gave a buy signal right after Brexit, about right in here. And so we're still on that buy signal. Now you can see that this chart is up to date, by the way, through last night's close. And so you can see that we just made a new high. So this is still trending downwards. As long as it's trending downwards, no matter how low it gets, we'll still be on this buy signal. We use a computer program to sort of do a chess tree analysis on this data, which can help us decide if the ratio starts to turn, whether a change of trend happened or not. For example, you can see earlier this week, it looked like it started to rise there, but the computer program was saying no, it's going to drop lower because it sees what's coming off the 21-day moving average and more or less can estimate what's coming on. Therefore, we stayed long. Now, as computers got more sophisticated, more powerful, we were able to calculate what I call the weighted put-call ratio, or what is called the weighted put-call ratio. And in this situation, the way I treat it is this way. At the end of the day, we compute the dollar volume of each option by taking the option's closing price and multiplying it by the volume that traded that day. So now we're talking about how many dollars this option traded that day. And so we sum up the dollar volume of the puts. Separately, we sum up the dollar volume of the calls. We divide the two, and again, we have the put-call ratio. So now we're measuring the dollars being spent on bearish opinion versus dollars being spent on bullish opinion. That's usually a better measure. You get more extreme readings, which is good, and you get more accurate ones. Now here's the current equity-only put-call or weighted put-call ratio. Again, all stock options are trade, but now we're looking at the dollars that were spent on these. By the way, over here, 160 means that $160 are being spent on puts for every $100 being spent on calls. So again, you see we had, again, similar buy signals, buy signal last September, sell signal November, buy signal February. Not so noisy here in recent activity, but again, some noise, and then a buy signal here in early July, and now we've fallen all the way down here, which is actually the lowest we've been. It's the lowest on this chart, but it's the lowest since the first quarter of 2014. But again, as long as the ratio continues to decline, it's still on a buy signal. It's only when it starts to roll over and rise would a sell signal come into being. So just to summarize here, both these ratios gave sell signals gave buy signals at the February bottom, and then again here in early July. They're both low on their charts, meaning they're overbought. But as I said at the beginning, overbought does not mean sell. It just means, be alert. And the computer analysis is taking into account what's happening. So the computer is still saying these things are on a buy for now. So overall, this is a positive indicator as well. Now, there's another put-call ratio I want to just touch on here. That's the total put-call ratio. This is all puts and calls that trade, so not futures options, but everything else. So ETF options, index options, and stock options. And we only use this to generate buy signals or to observe buy signals, and they're very powerful when they do occur. They call for a 100-point rise in the S&P 500, and we had one on June 2nd. So we went up for a ways, then we had Brexit, and now we're rising again. The target for this is 2205, meaning that it was at 2105 when we got the buy signal. So again, it's a 100-point target here. We have a system around this that has some stop outs to it, but here is a chart of S&P going back a couple of years, and here's the total put-call ratio right here, and here the scale is on the right, and here's 90. 90 is a significant area, so when it gets above 90 and peaks, that's a buy signal. So you had a buy signal there. This is the one we just had in June 2nd. It got above 90 and peaked. We have here a couple, again, the nomenclature is the same. Red signals are positive results. Blue signals, or the blue Bs, are not positive or less positive, and then green means that one's still open. So we had one here that it went above 90 and then came down and went back above. It was stopped out. So we had a small loss on S&P at that one, a small loss on this one, and the other three made their 100 points. This system has a very good track record, and again, as I said, we went long on this at 2105 back on June 2nd. So here's some individual put-call charts, because we do look at individual futures and stocks on this, and only one of these is real current that you'll be able to use, but I just wanted to show you how it can work out. This is U.S. Steel, and while some of the signals, the older ones, may not have been all that wonderful, you can see that the ratio got very extreme here. It got up to 800, this is weighted ratio, $800 being spent on puts for every $100 being spent on calls. That's very extreme, and so we used that as a buy signal and got a good trade out of it. Then it fell all the way down just a couple of months later to only $100 being spent on puts for every $100 being spent on calls, and then it rolled up. When it rolled up, that was a sell signal, so that was decent. It was in this area. Then we got another buy signal in here, and we're still holding off this buy signal. Now, it's gotten very low, but it hasn't started to curl up again yet, so we haven't gotten a sell signal from there, but one may be forthcoming pretty soon. But this, if you've been following the steel stocks, you know they're very good, and they were way out of favor early in the year, and it's been one of the bigger turnaround stories, and this is a good way to pick it up with a tech indicator. This is Seagate Technology. The only reason I'm really showing you this one is that you can see the ratio got way up to an extremely high level. In fact, actually, that was the highest it had ever been, almost $400 being spent on puts for every $100 being spent on calls, and then it turned. And so that's been a good trade as well. And what we do with these trades, as long as the put-call ratio stays on its signal, in this case buy signal, we maintain a position in the options, but we do roll them up to higher strikes as we go along or as we come to an expiration, so we're taking credits out of the position as it moves along. Here's MasterCard. This has a pretty long-term and significantly good track record, and it gave a buy signal a couple of weeks ago. This one right here, but you can see other buys in this extreme area. This one was actually kind of a double buy, but it did eventually result in a good trade. And here you had a buy, and I don't know if you want to call that second one there a little buy or not, but again, a pretty decent trade. By the way, the scale is not there for the stock price, just for the put-call ratio. Here's orange juice. This just gave a sell signal, and you can see that we broke down kind of simultaneous with that signal, and now we've even gone lower. This is a continuous chart of orange juice up here on top, put-call ratio on the bottom. And I finally said I was going to show you the current one. This is Caterpillar. It's had a pretty good track record. Even this sell signal here wasn't too bad, but it had a really good buy signal there, then a sell signal which resulted in a decent trade. Another buy signal running up to now this level, and now we've just had the sell signal. So you can see this, I'm just going to draw it next to it. It's curled up like that, and the computer programs are verifying this is a sell signal. However, there's support here, and this is 81 on the chart. The support there, it touched 81 once, it touched 81 twice, and now it hasn't come back below 81 again. So we're using this as a conditional recommendation. If it closes less than 81, then we're going to buy puts. But if the chart of the stock can't confirm what we're seeing for the put-call ratio, then we're not going to take a position. All right, so that's our first two indicators, the S&P 500 chart and the put-call ratios. The third thing we look at is market breadth, and there's a lot that goes into this, but I'm going to try to keep just the simple stuff here. Breadth is the daily total of advancing issues minus declining issues, and there's a couple of things you can do with it. You can keep a cumulative total, which we do, but I'm not really going to discuss that so much today, and we can calculate what's called an oscillator. But before I get to that, I just want to point out there's couple of ways you can look at breadth. New York Stock Exchange breadth, which is the most commonly reported one, has a lot of things in there that are not stocks. New York Stock Exchange trades a whole bunch of preferreds and bond funds and other things that are not stocks. And this is just a chart I'll quickly show you. It occurred to me, this actually happened when we started following the non-New York Stock Exchange chart. It was about the summer of 2001, right in here. I happened to be watching TV. Somebody say, well, the New York Stock Exchange advanced decline ratio just made a new all-time high, the cumulative ratio, the cumulative total. And you can see there it did. I mean, it's the highest on this chart. Just take my word, that was an all-time high. But the market was weak. We just had the period where Soros sold out his stocks, and the market was really not doing well. And I'm thinking, like, that doesn't seem right. So we said, well, we have a very easy way to look at a set of stocks only, and that's stocks on which options are traded. So we calculate what I call the stocks only advanced decline line using all optionable stocks, and there's actually nowadays a few more optionable stocks than there are New York Stock Exchange stocks, but there's about 6,000 of each. Back then there wasn't quite as many. And so I arbitrarily put them equal here on the first day of 2000 and just ran it forward, and you can see already by that time there was a big discrepancy, and then it just kept getting bigger and bigger. The thing that was going on was decimalization was coming into play. That's the first time we'd gone from trading in eighths to trading in pennies. And when we were trading in eighths, these preferred stocks and things on the New York Stock Exchange would not change much during a day in which interest rates fell by, like 1/10 of 1% or something like that. But when we started trading in pennies, they did. And that was a time when the Fed was lowering rates. So these non-stocks were advancing issues quite often and were making the New York Stock Exchange advanced decline line go higher, whereas in reality, stocks only advanced decline line was going lower. So we compute oscillators using both statistics. I still do the New York Stock data because it can be meaningful at times, but we keep also the stocks only. And we keep an oscillator, and the oscillator is equal to 90% of yesterday's value plus 10% of today's advances minus declines. So if anybody's interested in keeping this on your own, just shoot me an email and I'll give you the starting value, and then from then on you can calculate it yourself, because you have to know yesterday's value or the starting value in order to be able to calculate this for yourself. So here's a chart of the S&P on top and the oscillator on the bottom. Now this is the stocks only one using optionable stocks, and the oscillator, by the calculation on the previous page, I consider it to be overbought if it gets above 200. And oversold if it gets up a little minus 400. But again, as I said in the beginning, overbought does not mean sell. So here's the most overbought period in history. The beginning of March of this year, that was about right there, and you can see the S&P went straight up afterwards. In other words, there really wasn't any problem until it stopped being overbought. Once it comes out of the overbought area, that's your sell signal. And same here, last fall, oversold. We got very oversold in January of this year, and then a relapse in February, and then we came out of being oversold, and that was your buy signal in in early February, somewhere in there, right in there. So we We use this fairly often. Right now, it got very overbought, almost as overbought as it did in March, but not quite, and it's still hanging around barely in overbought territory. So again, we have not yet gotten a sell signal from this indicator. Breadth is positive today, at least was last time I looked. Yeah, it's modestly positive. They were positive about 500 issues on New York Stock Exchange. So, you know, it's not going to give a sell signal today either, but it could be halfway close to giving one. But in any case, right now, both of the breadth oscillators, whether you calculate with New York Stock Exchange data or with stocks only data, they're in that overbought condition, but they're still on buy signals. They won't be on a sell signal until they come out of the overbought condition. Earlier this week, in fact, that what day were we down? Tuesday, they came out and went right back in again. So those brief sell signals were canceled out. And so as long as these things stay in this overbought condition, we're bullish. They're bullish indicators. So the last thing I want to talk about is VIX and the volatility complex itself and the various things going on in that complex. There's a couple of things I want you to understand about VIX. I guess the number one thing I might say is that there's a lot of bad information about VIX on TV. People will say, oh, well, you can buy the VIX. You can't buy the VIX. You can buy derivatives based on the VIX, but they can be substantially different than VIX itself. Now, all of these ETFs and ETNs and futures and options, all on VIX and various other things like VXX and UVXY and all that kind of stuff, they are not VIX, and they will not necessarily move like VIX does. But the trend of VIX is important to the stock market. So if VIX is trending downward, the stock market should be going up. And conversely, if VIX is trending upward, the stock market should be going down. So one of the things that we really see a lot of, well, not a lot of, but a few times a year, we get these spike peaks in VIX. Those are buy signals for the stock market. I'm going to show you those in just a second. Conversely, that happens when the market collapses and VIX goes shooting higher. Conversely, when the market is bullish for long periods of time, like it is now, VIX gets very low on its chart. And again, that's an overbought condition, but the market can still go higher while the market is overbought, or while VIX is overbought. So it would not be bearish until VIX actually begins to establish an uptrend. So this is a one-year chart of VIX, and what's marked on here are the various VIX spike peak buy signals. So I'm just going to, here's the big one last August, if you recall. It's when we broke down very sharply. VIX went shooting up to 40, came from a very low level, shooting up to 40, and then spiked right back down. That gave us a buy signal. Did it again a few days later. It did it again at the end of September on the retest of the lows. Did it in November. There was a decent buy signal there. Another one in December, and then a couple of false starts again, as was the case before. The blue Bs are losing signals. So you can see here, this looked like a spike peak, but then was superseded a couple of days later. So that canceled out that one. Eventually, we got this buy signal, and then we got one right at the February lows, and then we did not have another one all the way until Brexit. We had a false one right before Brexit, and then an actual one during the Brexit time. So this one was June 20, I think, 7th. And now the system that we use says that these buy signals last for 22 trading days if they're not stopped out. So that one has now, last week, was expired and did very well. But these are definitely worth trading. We pay attention. We watch for these a lot. You can see here that for most of, I'll change the subject a little bit, for most of this year, VIX has meandered around in the 13 to 17 range, except for that Brexit bump out of there. It just meandered sideways, and as you know, the market was going up pretty steadily from mid-March all the way to right before Brexit. Now we've dropped down to where VIX is actually below 13. It's below 13 today. In fact, it's at 1254 right now. And so some people are saying, oh my gosh, this disaster is at hand. Well, as I said before, as long as VIX is trending lower or sideways, the stock market can continue to rise. It's not a problem for stocks. What would be a problem is if VIX breaks out here above, well, that's about 14, and starts to establish an uptrend going higher, then that would be bearish for stocks. So right now, we're just kind of nominally saying, as long as VIX is below 14, you really don't have anything to worry about. Once it breaks out over 14, then you can start to worry. You can start to take some defensive actions. So the current, I guess the summary of that chart is VIX is trendless, so that's bullish for stocks. That close above 14 would be bearish. But here at 13 or below, VIX is overbought, but that's not a sell signal. And that recent buy signal did expire. Now, there's another thing that is very important about the VIX futures and also about the CBOE volatility indices, and I'm going to touch on those both right now. First of all, the VIX futures trade at a different price than VIX. They'll trade at a premium or a discount, so that's important. Secondly, the term structure, in other words, here's your August futures here, September futures here, November, October, November, etc. The term structure is how they line up. That's important too, especially whether that term structure is sloping upwards or downwards. So it's bullish for stocks when the VIX futures are trading at a premium and the term structure slopes upwards, which is the case most of the time. So most of the time, the market's going up. But when that stops happening, when the futures start to trade at a discount to VIX and the term structure slopes downwards, then that's when sell signals appear. Well, right now, we're in a fairly bullish situation, which I'll show you in a second. But I want to squelch one myth that I hear over and over and over again on television, especially on CNBC, is that somehow or other these guys will look out 5 months in the future and they'll say, oh, well, VIX is 13 today and the 5-month future is trading at 18. So professionals are saying, oh, volatility is going to go from 13 to 18 over the next 5 months, so the market's going to have to go down. That's not even close to being true. It's completely false. What's really going to happen, if nothing else happens, is that this 18 will decay to become 13. And in fact, professional volatility traders call that the big short, or the big volatility short, and they sell that, try to make that that time premium by selling those medium-term futures and hoping to cover them for a nice profit when they become short-term futures. But why is this the case? Let's see if we can figure this out. So implied volatility on the near term, implied volatility of S&P 500 options can range all over the place. I mean, in a really dull market, implied volatility and realized volatility can get down in the 5 to 10 area. In a crazy, bearish market, they can get all the way up in 45 to 50 area. So right now we're fairly benign. VIX is at 13. So near-term volatility is 13. VIX is a 30-day volatility measure. But what if somebody came into a market maker and said, I want to buy a 3-year option, 36 months to go? What volatility is that market maker going to price that with? He has no idea where volatility is going to be in 3 months, 3 years. But he'll say, all right, well, I'll just use the average volatility. So the average volatility of, let's say, this index is about 25. And so he'll price that option at 25. So now we have 2 data points. We've got the near-term option, which is going to be trading with an implied volatility near VIX. And we've got the long-term option, which is going to be trading with an implied volatility near the long-term average. All right, so let's step it up a bit. So now somebody comes in and says, well, I want to buy an option that's 2 months out. Where do you price those? Well, the market maker says, well, VIX is low. I'll price it a little bit higher, reflecting some uncertainty that I don't know where volatility is going to be in 2 months, but it's low now, so it's probably going to be relatively low. And some other guy comes in and says, I want to buy a 2-year option. Where are you going to price that? Well, again, a little bit below where this one was because there's less uncertainty over 2 years than 3 years, but not much. So it's still going to be very expensive. And then finally, somebody comes in and says, oh, I want to buy an 8-month option, and this guy says, I want to buy a 16-month option. Where would you price those? Well, in between. So what do we have? We have the term structure sloping upwards like this. So, here's today VIX is 13. And here's, a few, 8 months later or 7 months later, and this was priced at about 18. It does not mean at all that volatility is going to go from 13 to 18 in the next 8 months. It just means due to the uncertainty of time and volatility, that's where the market makers are pricing 8-month options. And that's all it means. It has no predictive value other than to say that when the term structure is sloping upwards, it's bullish for stocks. When it slopes downwards, the opposite kind of occurs, because in an opposite situation, the near-term volatility would be up here, and then these others would slope downwards for the same kind of reasons due to uncertainty of going out over time, and that would be bearish. So upward sloping term structure, bullish for stocks. So here's the current one. This is last night's closing prices. VIX closed at 1286. The near-term futures, the August futures, which expire, I think, on August 20th, and they're, August 17th. And so they're fairly near term, but they're trading with a premium to VIX of 97 cents. But now we just go out 1 month beyond that. The September futures are trading at 16 and change, a premium of 342. That's a big jump up in premium. And the 3-month future, the October futures, are trading at 18. So this is where I've got this, 13 current, 18 actually in 2 months, and that's a huge premium of $5.14. So what professionals do is they sell this future and try to hedge their volatility risk. In other words, it could be wrong. It could be another October massacre or something and VIX explodes, so they'd want to hedge their risk. And how would you hedge an exploding volatility? Well, you'd buy some S&P puts because those would go up if volatility went up. But you can see here the term structure slopes nicely upwards. Each one is higher than the one before it, and each premium is a little bit bigger than the one before it, and that's all wonderfully bullish, because that indicates that volatility is low here and the term structure slopes upwards, and that's normal, a normal bullish market. Now, you can do this without paying attention to all the futures in a simpler manner. I call it the poor man's futures construct, and that's to use the CBOE's volatility indices. They have 4 volatility indices. There's the VX short term, that's a 9-day volatility measure. There's VIX itself, which is a 30-day volatility measure. There's the VXV, which is a kind of a 3-month volatility measure. And then there's the VX medium term, which is a 6-month volatility measure. Here's where those stood last night. Again, you can see they're sloping upwards. The term structure slopes upwards, just like the futures, and just like the futures, an upward slope is bullish for stocks. So again, we have another, bullish indicator here. So, that situation is all nicely bullish. You can use these for some other ways to look at buy signals, and this is these CBOE volatility indices. I already showed you the VIX spike peak buy signal, but there's another one, we call it the crossover. So normally, due to the fact that the term structure slopes upwards like this, VIX is this one and VXV is this one. Normally, VIX is below VXV. But occasionally, when something bearish happens and the market gets out of kilter, VIX will close, well, not this closing price, will close above VXV. That's an extreme oversold condition. It means that the term structure is sloping downwards, and it means that bearish things are happening. So we don't want to just jump in and buy while bearish things are happening. We want to wait for the bearishness to end. And so once it's been above and then goes back and closes below again, gets back into the normal bullish state, that's the time to buy the stock market. So last buy signal we had from this measure was on June 28th, a couple of days after Brexit. And this one is a short-term indicator that made really good profits in the first 5 trading days, and we were in and out on that one. This chart goes back to, let's see, 2014. September 2014 is about a 1-year chart here. The red lines are buy signals from this VIX crossover buy. You can see a couple of times we've had like a false start and then a rebuy, but they're pretty good buy signals when they happen. And over the short term, as I said, they're like 5-day trading signals. This one was not so good, but then this one was good. And it's a little hard to see these in here because the market was jumping back and forth, but those are good. That one was not, and then this was a good one. And then in the last year, again, we had a number of them, including one right down here at the February lows, and also, last October at those lows. So this is definitely something very simple that you can watch for and pay attention to yourself. You don't have to pay anybody any money to keep track of it for you. You can just watch it yourself. There's a second one, and this is the VXST crossover. Now remember, again, there were 4 indices. The short one is VXST, and then VIX, and then VXV, and then VXMT. So normally they look like that, but occasionally VXST will rise above all of the others, so it's higher than all of the others. The term structure will be sloping downwards by that time that happens. That's a very oversold condition too, and when that happens, you just observe, and then when VXST, the short-term one, subsequently closes below any of the others, that's a buy signal. Again, we had a buy signal on June 28th. This one has a little bit longer term lasting, so we're still holding from that buy signal, and we rolled calls up, of course, a couple of times because the market has gone up quite a bit since June 28th. So the conclusion of volatility, is that VIX is trending sideways, so that's bullish. The VIX futures construct is bullish because the term structure is sloping upwards and the VIX futures are trading at a premium. The CBOE construct is bullish, and the VIX breakout above 14 could change that. So to summarize, and we're coming to the end here, I got a little bit of a late start, but here's our opinion right now. The SPX chart, bullish. Picard ratios, bullish, overbought, admittedly, low on the charts, but still bullish. Breadth oscillators, buy signals, modestly overbought. VIX, bullish, overbought because it's below 13, and the term structures, bullish. So we have no sell signals, is my point here. And we just did a study on market tops, which we published last week, and we're going to be doing a webinar about that probably next week on our own website. And that when you don't have any sell signals, don't be short. You will have time to get short when the sell signals start to appear. And just because the market is overbought is not a good reason for selling. So right now, we remain bullish. We're vigilant. Of course, we're not going to relax and become complacent and start throwing targets around. We'll watch the indicators daily. But right now, there are no sell signals. And just anecdotally, I wrote this in May, but except for the first one, you could pretty much say the same thing. S&P is at the 2100 level, always falls from there, right, in the last year and a half. VIX is too low. The Fed's a problem. They just always seem to be causing the market a problem. The election, not just Trump, the whole thing is a problem. The global economy is a problem. Every big guy you know is short. Soros, Icahn, this new guy came out this week, he's short. The guy from Bill Gross, they're all short. All the big names are short. Just watch TV for a day or two. So it must be easy to go short here right now. No, wrong. First of all, it's never easy. And secondly, if all these guys are short, I don't care who they are, you probably don't want to be short yet. Wait for the sell signals. So as I said, if you go to this website, you can get discounts on our products. You will be receiving a copy of the PDF of this presentation via email. And if you want to get a hold of me, like to get that starting value of that breadth oscillator, then just shoot me an email. There's my email address.